Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is Deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On this show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions, capital raising, joint ventures, strategic alliances, real estate, affiliate and sponsorship deals, franchising, and more. My name is Corey Kupfer, and I've been supporting deal-driven growth for businesses for over 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the DealQuest Podcast. Let's get started. David Lau is widely recognized as an innovator and disruptor in the financial services industry. He is the founder and chief executive officer of DPL Financial Partners, a privately held financial services firm that specializes in development and distribution of low-cost, commission-free insurance and annuity products, as well as technology-driven product discovery tools and education for registered investment advisors and individual investors. Since going to market in 2018, DPL has worked with 20 leading insurance carriers to bring a range of value-driven, no-load products to its turnkey insurance management platform for advisors, and built an advisor base of more than 10,000 advisors at more than 3,500 RIA firms. He's a sought-after speaker and commentator. The number of publications he's been in, New York Times, Barron's, wealthmanagement.com, CNBC. I mean, it's nothing as impressive as being on the DealQuest podcast, but he's done pretty well before this. David, welcome.
I had to earn the credibility to get
right to make it on the show. Exactly. Cool. So, David, listen, I want to get into all that you do and this great company you built and how it affects advisors when they're doing M&A deals and things like that. And also, you've had experience raising capital, so there's a lot of deal stuff to talk about. But before I do any of that, I want to take you back. We were actually talking, funnily enough, we're recording this on Halloween, so we were talking a little bit about our trick-or-treating experience as a kid compared to now. So, but not specifically about trick-or-treating. I want to take you back to when you were 8, 10, 12 years old. What did you want to be? Because I am pretty sure that being a founder of insurance and annuity platform was probably not it at that age, but you tell me.
No, I mean, and actually being a founder of an insurance platform wasn't even something I wanted to do when I was a grown-up.
Right.
It's just something that kind of evolved. Most kids at like 10 years old, I want to be a professional athlete. I want to be a football player, baseball player, something like that. What better than, and that's before salaries were outrageous, right? I mean, now I'd 100% want to be a professional athlete. But then as I got to, and I was always a pretty good athlete, but then as I got to high school and then actually played, then you realize that you need to be 6'4". Then you quickly realize that that's not going to happen. And maybe I got to figure something else out. I was never one of those kids growing up or even in college like that. I had a real clear idea about what I wanted to do. My career, I think, is, a little bit happenstance in the beginning. And then, got pretty intentional after that. Many kids, even after you graduate college, you wind up in a career based on kind of the job you got.
Yeah, it's fascinating. Funny, I laugh because it's certainly not unusual for our guests to say they want to be some sort of, baseball, football, whatever it is, basketball player. We all get very realistic, and it's often in high school, not if you're a little better, maybe in college. And I can jokingly say it's actually true that I lettered in a sport in high school. Now, when I say it was bowling, it's a little less impressive because that was the only team I could make in my high school was the bowling team. So that's the extent of my sports notoriety.
I did letter in a number of sports, but the thing when I was a freshman, I played in a summer league basketball game and we played against Johnny Dawkins. So if you remember, Johnny Dawkins played for Duke and then played in the NBA a lot. I was covering him. He got an alley-oop pass where he basically jumped over me like his ankle was going by my ears to dunk the ball. I've never seen anything like it in my life. And at that point, I'm like, any thought I ever had of playing basketball at any level, like that's a whole different ball game.
Right. It's not even like, oh, that person's a little better than me. It's like they're playing a game that's a different game, right?
Entirely different game. I thought I was about to go up for a rebound. And instead, the guy's just throwing an alley-oop pass to the guy to jump over top and done.
I love it. One other deal looking back, one other question looking back, which is, what was your first deal of any type? It could be something professionally, or it could be something smaller when you were young. Anything you consider a deal.
My first big job, I would say I was the chief marketing officer of the first internet bank in the country. And it was, called Telebank. It was even a direct bank pre-internet. And as part of the executive team, I was part of capital raising. And before that, like those are, you put some business partnerships or deals together, and that's kind of cool. But raising capital, like that was a whole different ballgame. And that was super interesting. And we wound up doing, I think, 3 different capital raises in 4 years I was there. We raised a little over $500 million for the business, and doing those deals were super cool. In particular, when we were getting ready to go public and we're going around pitching all kinds of mutual funds and other institutional investors on why our stock should be in their mutual fund or in their portfolio. And the run up of the stock during that time, we were kind of publicly traded on the pink sheets, but price in like the month that we were out capital raising, to get ready for the bigger public offering, the stock went from 17 to like 150 in like a few weeks. And Goldman Sachs had to kind of the price down, like get it to a place where all these people that were interested would still be interested. And we ultimately struck the deal at 105, and tremendous experience.
I love it. So let's stay on the capital raising conversation for a moment, because it's interesting. I actually just recorded an episode with Dave Hirsch, so that it'll air before yours. So if people are listening to this, they can look back in episode or 2, whatever. Dave was a founder, raised capital, and he spoken at the Entrepreneur Organization Deal Exchange Conference that I chaired a couple of months ago. And we also had somebody named Fallon Fatemi, and Fallon literally grew up in Silicon Valley, like literally grew up, groomed in that world, and had a number of funded companies. Mark Cuban's one of the major investors in one of her companies. And the interesting part is that both of them, so Dave now does a lot of coaching and consulting for clients, and he talks about a lot of the downsides of raising capital and the pressures and things like that. Not that he says that nobody should raise, but you need to be aware of what's involved in that. Fallon, who had a number of very successful funded companies, has recently become a mother, and she has said, I'm never doing another funded company. And again, not that I regret. It's just at this stage of my life where I am and whatever the company's going forward, I'm not going to get funded. So I would love you to weigh in on, having been through that experience. I know you have funding in your current company. Just weigh in on that funding decision and what it means to companies. And there's upsides and downsides, right? Let's do it right or wrong.
100%. There are trade-offs, right, to raising capital. And frankly, when I launched DPL, had just come out of another private equity-backed company that we'd built and sold. And when I was launching DPL, I'm like, I'm bootstrapping this. Now gone through that cycle a few times and don't want to necessarily repeat it. And then as I was getting the business together, and I got introduced to my first investor, who's an amazing guy named Todd Bowley, who people might know from his sports investing. He owns Chelsea, he owns the Dodgers, he owns part of the Lakers. And getting to meet Todd, I was introduced to Todd, and was pitching him the business and what I was doing, and he wanted to invest. How do I not take money from that guy? So the pros and cons, you're signing up for growth. You are signing up for going hard, and you're signing up for early years, certainly 100% growth year after year. One of the things that really struck me when we were at the bank, our founder said, when we were about to go public, like meaningfully go public, we were making that decision. We were going to go try to raise $500 million, go, off the pink sheets, meaningfully public. He said, the thing is, if we go do this, it's going to change the company, because it's no longer going to be the company that we control and we're just growing nicely. We're going to be meaningfully public, and a number of the people that have helped us get here aren't going to make it. We're going to outgrow them. That to me is one of the hardest things of it, is you start building a company and really good people who have helped you get from one stage to the next aren't necessarily able to the following level. And it's not necessarily that they see it either. And that's one of the really hard things to do. But you're signing up to take that capital, you have to know you're going to go through phases of the company. You're going through that early startup phase where the world's your oyster and it's all a possibility. And you've got venture capitalists who are the optimists, and they see your vision and they're super excited. And then when you get to the private equity, they're no longer the optimists. They're the guys who see all the downside. They're the guys who see everything that can go wrong in your model. And they're taking a very different, more institutionalized approach to things. But you go through those phases of the company and you got to be prepared to do that with all that comes with it, both from the types of investors you're working with and the demands they're going to have, along with the internal challenges of pushing hard for growth all the time and outgrowing people. It's tough stuff. Big rewards to it, both along the way, and hopefully ultimately where you can have a successful exit, but it's not for everyone.
It's fascinating. And listen, when you combine that with all the stats of how many funded companies actually, you got to be aware of the fact that when you're talking about professional capital, like they just need 1 in 10 to hit, right? And that's usually the ratio, by the way. Like there's a guy I mentioned him before, like out of the UK did a big study years ago. I wish I remember his name. And, I've seen studies since then. And basically, I mean, this is obviously there's variation, but largely of every 10 portfolio companies, 7 of them actually go nowhere. 2 of them do okay, and hopefully 1 of them hits. So from a PE, professional investor point of view, whatever, that works because they make more money on the one that goes crazy than the other 9. But from your point of view, you're the founder or executive team. If you're not 1 of the 10, and certainly if you're in the 7 of 10, it's not so good, right?
It's tough, and you definitely want to surround yourself with really good people, because as good as your business idea might be, it is hard to get funded. Even me, where I've been in a part executive in several different successful businesses, really good exits, it's still hard to get funded. But people will fund, as again told early in my career from investors, will invest in an A management team with a C business plan ahead of management team and an A business plan, because your business plan that you drew up the first day you're building your business isn't going to be what it is 3 or 4 years from then. So you've got to be good people at the top who can adapt the business and take advantage of the market opportunities you create.
The industry's created these great words like pivot. What pivot means is that what you thought was going to work didn't work, and now you got to do something like different. Like pivot sounds very nice, like it's this easy thing. We're just gonna pivot a little bit. No, 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 no. Like you're in trouble. It's not working. The model that you thought was going to work, or the specific product or whatever, and you got to figure out a new way. Yeah, and that's why the management team is everything. And listen, with everything people say about the downsides of professional capital, it is nearly impossible to grow at the rates that funded companies grow, right? And especially if you're in certain kind of ventures. I mean, tech's the classic one, where you have other competing companies that are trying to get ahead of you in the market. There are certain ventures where if you don't take capital, you're going to be dead because you're going to be, I mean, the funded companies blow you away.
Exactly. So even if you're the first mover, you get out there and it's like, hey, somebody's going to say, hey, what a great idea. I'll go raise a bunch of capital and I'll bypass them instantly because I can go spend more. It's hard to bootstrap a company. I mean, you can do it. I kind of did with DPL for a very short period of time, about 6 months. But ultimately, if you want to build a big and successful business, you're going to need outside capital and getting the right partners. I think people can sometimes get excited that somebody's offering them money and I'll take the money. All money's good money. The relationships and the partnerships matter. The right people can really help you grow your business, can help you get to the next stages. So it's really important that as much as you can, you be a little picky about the money and the partners you take it from.
Yeah, I think great part is what other strategic value do they bring beyond cash? The truth is, you're right, it's hard to raise capital, but the companies that are fundable, that are really great, right, usually can find money somewhere. But then the question is it the right people? Is it the right money? Are they aligned? Do they bring other strategic value? Are they truly a strategic investor? Even if they're a financial investor, though, do they bring other strategic value, connections, introductions, expertise, all that kind of stuff? Yeah.
Absolutely. And that can be particularly when you're a smaller company and you don't have the resource for a lot of that expertise. and you can leverage some of their network or some of their internal talent for ideas or thoughts and guidance and connections and all that, that it can be super helpful.
Love it. So listen, you've certainly, I mean, 20 leading insurance carriers, 10,000 advisors, 3,500 RIA firms. I mean, obviously, that's super impressive. A lot of listeners know we do a huge amount in the RIA space. So I know what kind of market penetration means. So tell us more about specifically what DPL does.
So basically, you're kind of looking at the world. I was mentioning I built an insurance carrier prior to this called Jefferson National, which we sold to Nationwide. And building Jefferson National kind of realized a few market problems, right? One, the RIA industry is booming. It's growing like crazy. When we first launched that company, I think the collective assets in the RIA world were like 600 billion. Now there's firms who have that much. The world has changed quite a bit. It's closer to a $10 trillion market now. And even beyond the RIA market, advisors have migrated their business practice from transactional revenue to fee-based revenue. They're getting paid by their
Yes.
clients rather than product companies. And
Yes.
in the insurance world, that just hasn't changed. The insurance world is still largely driven by commissions. And in building a carrier that was focused on the fee-based world, I kind of understood all the issues and could see what the problems were that the carriers were having in trying to serve this world. One, the better approach was going to be to build a marketplace rather than be the manufacturer as we were. Set out like building relationships with carriers to teach them how to build products that could work in this environment, and then build technology to be that interface. Because as I looked at the world, I'm like, the two kind of structural reasons that have prevented insurance from coming along like the rest of asset management to this fee-based new reality were structural. There were no products, or the products that existed didn't work in a fee-based world. As I'd tell a carrier, you wouldn't launch a commission product that couldn't pay a commission. You got to let somebody bill a fee out of it, right? I mean, they're
Somebody's got
fiduciaries.
to make money somehow, right?
That's right. They're fiduciaries. They're not saints. So they still need to get paid. And then technical barriers where in the fee-based world, whichever channel, asset management is happening within one system, annuities are happening on another system, and it's pretty much just an application system. So they're siloed. So in order to make annuities work in a fee-based world, you had to get them into the portfolio management system, which is why we partner with the leading portfolio management systems like Orion and Black Diamond to bring our technology into their platforms as well as the data and the products. So now it works, which is kind of the key. And the benefit to the firms we work with is really effectively organic growth. And the products are insurance, but the benefit to the firms are organic growth. And so if you've been a traditional RIA who's probably never used or really even maybe liked insurance, particularly annuities before, we give you a way of aggregating assets, bring in those held away assets. Your clients own annuities. Annuity market's a $5 trillion market. For a long time, it was bigger than the RIA market. Your clients own annuities. We give you tools that can instantly compare them and bring them under your management and keep them away from competitors because, oh, by the way, every insurance agent now wants to manage your client's assets too. And then for the hybrid, and this is where we really come full circle back into the deal structures, is for the hybrid advisor who's liked annuities, used annuities, it's really the last thing they're doing on a commission basis and the only real reason they still need a broker dealer. What we're able to do for them is migrate those assets to fee-based assets. So the client gets a massively better product. The advisor is now getting more revenue and better revenue when it comes to deals, right? They're going to get, maybe 3 times the amount of revenue they might have been generating from a trail, and they're going to get probably 5 times the multiple that they would be getting on that business. Or if you're an aggregator, we're going to do it for them. So if you're an RIA firm thinking about maybe I want to be acquired and you've used annuities before, do it with us before you get acquired so you can get the benefit. Or once you do, the firm's going to work with us and migrate those assets.
Yeah. We've done hundreds of breakaways. We've done huge amount of M&A. And so let's start at the breakaway stage, right? We're always evaluating with clients, okay, are they going to be on fee only? Or are they going to be, most of them at least, mainly fee-based, the majority, but do they have any kind of brokerage, whether annuity is something else that they need to maintain? And there are some that it's minimal and they decide to leave it behind, right? So just because they don't want to have to maintain a BD relationship, okay, well, this allows them to potentially, right, take it without having a BD relationship. There are some where then it's larger, and you're right. It could be just because of annuities that they have a friendly BD relationship, right? And then certainly on the multiple side, there's no question its assets get a much higher multiple. So when we have private clients and we're doing M&A deals, we see how buyers are valuing that, and they're certainly valuing the recurring revenue and the fee-based revenue. I mean, I say this all the time to my hundreds of RIA clients. I'm like, listen, you guys have a fee-based. Like I joke that we do very similar work, right? Me as a lawyer, the type of law that I do, and what they do is, right, we provide high-end, fiduciary level advice to very successful people, or that kind of stuff on stuff that's really important to them in their lives, right? That's what I do. That's what they do. They just have a much better business model than I do as a lawyer. Recovering revenue, generally recovering revenue pulled quarterly in advance out of a custodial account, right? And that's why PE money and all this stuff is coming to the space. I was surprised because I've been in this industry forever, and I was surprised like it didn't come in earlier. But I would sit there saying, "This is an amazing industry. Oh my God, you got these sticky client relationships. You got recurring revenue. It's paid in advance. You got people that it would be career suicide for them to have financial, not repay a loan or whatever it is. Like, why isn't there more money in this space?" And of course, it eventually came in. But it's a whole different game on commission-based business. It's not valued the same, and it shouldn't be.
Yeah. And I think equally as importantly, when you're thinking about monetizing a business, so not only is it not valued in the same way, and again, not nearly, but it also, if you convert it, it opens up options because there are a lot more firms willing to buy those assets when they're fee-based assets, or they're going to bypass you altogether if you're a hybrid firm. So if you want to remain hybrid, you're narrowing your potential audience of acquirers. When you're fee only and pushing to fee only, the number of firms who will be interested in you is much greater.
Yeah, that's 100% true. That's definitely our experience as well. So at what stage are you usually like, are you getting in with them when they're originally breaking on this conversation? Or do you when generally you realize you even exist and then you know it's an option
Yeah.
and then come in?
Well, we launched in 2018. It's been a progression. Anybody who started a business understands in the early years, you work with anybody,
Yeah.
right? So
Yeah.
if anybody is going to do business with you, you're willing to do business with them. And then over the course of time, you build up your reputation, your brand, your credibility, your capabilities, and you can start serving different audiences. But going back to the pivot notion, and I wouldn't call this necessarily a pivot, but kind of an evolution of the offering. So we built this commission-free product marketplace. And then we built great technology to analyze an individual annuity and go into an individual annuity account. You can take a photo of a statement. You can do a quick lookup in a tool. I mean, you can literally compare an annuity and find a new one in a minute. So it doesn't take any time at all. But now when you're talking about those advisors who are transitioning a book, they could have literally thousands of annuities at a firm. An individual advisor might have hundreds of them. Even at the efficiency with which we could do one policy, doing that across that kind of book is a lot of work. So it's okay, great value proposition, 100% love it, hard to do just because of the volume. We did have firms that were doing that and work through a book with them. But what we did in the last year was create that individualized capability into what we call mass capability. So now
Okay.
give us a data download of your annuity book. We'll tell you what data points we need, or even give us a photo, an image dump from your insurance carrier with statements. We'll read them thousands at a time and in minutes analyze a book of 1,000 policies and map them into new products and start the application by pre-filling the applications. And we can move, many more products at once. Not only obviously good for our business, but helps those advisors actually realize the benefit of the value proposition we have for them.
Love it. So listen, as you grow your company, I'm not going to ask you to commit to what your own exit is going to be, even if you think you have an idea. Like you have a phenomenal background and experience, right? You've been in a place that's it went public on the pink sheets and then went fully right public and raised capital prior to that. You've been in a place you sold a company, the insurance company before. We haven't even delved into that sale itself. So any lessons from there? But like, as you think about the various exits, and certainly it's interesting because in the RA space, that conversation, whether it's the aggregators, integrators that are buying up a bunch of people, or the testing of the public markets for the bigger players, which so far has not been, if you understand any industry that's evolved and matured and had capital come in and then whatever, I mean, an IPO market will develop at some point, right? Because as you go up the chain to the higher PE firms, sovereign wealth funds, all these bigger players, at some point, there's got to be public market exit, but we're really not there. But my point is, like, you've almost seen it all in terms of companies that have and ways and personally experienced it. So your thoughts on whether it's options for your situation or what you're seeing in the industry on these exit options and what makes sense for who?
Yeah, I mean, it's certainly going to be interesting to watch, right? So, I mean, we saw recently Edelman start going out looking like they were for sale and going to be acquired, and I think quickly realized they weren't going to get the multiple they were hoping for. But as you grow the business, your options for exit or a transaction narrow, right? Because people can't afford it at some point,
Right.
right?
Right. Yeah.
Your business is worth
Internal succession goes out the window pretty early. Then you get right.
That's right. You know, and that's what you see in a real challenge in this RIA consolidation market. What happens to Gen 2 advisors and they're no longer able to afford the multiples are crazy. You can't really unless you're a really generous person, you really can't sell to Gen 2 anymore. I mean, you're leaving so much money on the table. I think you're going to see a lot of people have been predicting you're going to see some of the consolidators consolidating. I think that's harder than people think because you've got two, they're all trying to create their own culture and their own entity. And now again, when you're doing that at a much larger scale, much harder, and you got to have some big bucks to drive that because all those firms are getting crazy multiples right now. And how do you make that happen? It will happen, or you wind up going public, but fewer firms go public. I think there's like 3 RIA firms that are public right now.
And then one's like Focus Financial that went public and then got taken back private, right?
Yeah, I mean, you've seen probably more of that, like, than actually people going public, but it's the benefits of going public often outweighed by the costs of going public, like the literal costs of all the reporting, and you've got to manage your business differently. You go from managing with a long-term vision of trying to achieve growth to having to hit quarterly numbers, or your stock's going to get hurt, sometimes significantly. So it's interesting. I think we're still going to see more and more money flowing in. I think a lot of people I hear from, good for your business, good for my business. I think there's still yet lots more money to come. We're still in the early innings of consolidation. So, and for as much as people think the industry is consolidating, I was just at an event, they were talking about it's actually still not consolidating.
It's not.
Because there's still more new firms coming into the market than ones getting gobbled up. So it's still a growing market and still a disaggregated market. And there's going to be loads more deals. And I do think you are going to see the aggregators consolidate and you are going to see a couple go public.
So again, you've had this experience with a company that's gone public. You sold the company. Talk to me about some of the lessons you learned.
One of the hard things going public, I remember doing our first earnings call with our analysts and forget all the metrics we had, but I'm in charge of growth. The chief marketing officer, I'm in charge of growth. I think we've had a great quarter. We've gotten bigger accounts than we were anticipating. We raised a lot more, got a lot more deposits, more profitable accounts. We acquired them for less than we had projected, like all kinds of great metrics. But the one we didn't have was we didn't have as many accounts. But we brought in more assets because we brought in bigger, better accounts and we did it more efficiently. And so from a business point of view, that's a great outcome. Got the money cheaper, they're more profitable accounts. We brought in more money than we anticipated, but we got crushed because it wasn't as many. And particularly in those days, they're like, we want to see that there are more people interested in the business. Where all of a sudden you've got fear of maybe this isn't as widespread, maybe only rich people like this, whatever it is. And you're now understanding that every metric matters. And even if you're thinking we had a really good long-term business outcome here this quarter, like that doesn't necessarily matter. You do truly have to make quarter to quarter decisions. And that was not a great deal of fun.
Yeah. And it's interesting because anybody who studies the markets, whether it's from the point of view of running a public company or even, I think it's one of the reasons why a lot of our clients who are advisors try to tell the investors not to look at things on a quarter by quarter basis,
Right.
right?
Right.
You know, because you understand what happens in the markets. The funny part is that when there are earnings announcements, for example, whatever, the market moves not based upon what the announcements are. It moves based upon the gap,
Right.
if any, between the expectation the market had and what actually happened, right? So, like,
Right.
somebody could have a great growth, but if that's what the market expected, it's already been built in and nothing happens, right? But if it's beyond expectations, it's different. If you grow whatever 15%, which seems like crazy growth to you, but the market was expecting 20,
Yeah, totally.
it's
And that's all part you have to manage your analysts when you're going public. So because you want to work with them on their projections and make sure they're not out of line with what with what you think you can accomplish because it's going to affect your stock price. But and like you said, things like that get built in. I mean, one of the things I think a lot of firms don't realize who are in this either acquiring the acquirers know it now, but those being acquired, the acquirers are pretty smart. They're backed by some pretty smart people too, and they've done a lot of these deals. And just because you've been growing, because the market's been growing, don't think you're going to get credit for that. You're not going to get credit for that. What they want to see and what gets valued is not only the fee-based revenue, but organic growth. You really need to make sure you're growing organically. If you show real organic growth, that's probably the most valuable thing, you can be doing. And it's again why firms get attracted to what we're doing. We are organic growth. We're bringing in
yes.
Helpway assets. We're helping you bring in new clients, and everybody is looking for organic growth.
No, there's no listen, you mentioned the Edelman thing. I mean, the word is that one of the biggest factors that had them not get the valuation, we're making assumptions here, whatever, but seems to be that the market was not happy with their organic growth rates and they're going to be focusing on that and converting some of their retirement folks to getting individual accounts and that kind of stuff. And by the way, this is true across industries, right? Organic growth is valued across industries. But speaking specifically in the RA space, I mean, listen, there's been all kinds of reports, really other reports over the years. If you take out market, most firms are growing 3 or 4% true organic growth. And that's not a lot. So the market can hide. I've shared this before, but it's one of my favorite things. I was at an event many, many years ago. I was like probably 20 years ago with, there were 3 billionaires on this panel, right? And they were talking about how they had all sort of lost it and then came back or whatever. The host asked this one billionaire, like, what happened? What were your mistakes when you lost it all the first time? And his comment was that I mistook a bull market for brilliance.
Yeah, that's right.
I thought it was like the best line
Oh
ever.
yeah, 100%. Not to disparage the industry, but I mean that's a lot of people have done very well simply because of the market. I mean, somebody was saying at the event I was just at that if you're an RIA and 10 years ago and you did absolutely nothing over the last decade, you're making twice as much money as you were 10
Right.
years ago. So, I mean, you're in the right place at the right time with the market going up, and that's fantastic. But again, if you're looking to do a transaction, you're not going to get credit for that. So the acquirers, and particularly their private equity backers, want organic growth.
Yeah. And frankly, that's part of what some of them promise is to help these firms increase their organic growth because they have a broader range of products and services, because they have marketing teams and things like that. And some of them have showed that. I mean, there are some that have double-digit growth on platforms for advisors. So I want to hit one other quick thing before I go to my final two questions, because you did sell a company and we didn't talk about that. But the one question I want to ask you around that is, it applies to these advisors now, and a lot of them, I can't tell you how many folks I had that just a few years ago told me they got 10-year runway, and then they've called me since to sell because of the way the market has gone and the multiples have gone in the RA space. But more generally, like that decision on when you sell a business and why you sell a business, right? You were there, right? You ran a company. Now you're running obviously a different company. I guess you could have, I don't know the circumstance, but you could have continued to run the insurance company. What went into your mindset decision on when it was time to sell?
I mean, there were a few things. So one is that we were a small insurance carrier, and having a relatively small balance sheet for the industry, there were limited things we could do. So we really needed to partner with somebody with a bigger balance sheet. So it was a bit of, okay, this business has kind of run its course.
Yeah.
Yeah, in some ways. We've taken it as probably as far as we can take it. And the other thing was kind of the realization, which is what spurred me to build DPL, is that an insurance carrier isn't worth anything. We were a carrier, and that's very capital intensive to do. So when you're working with investors, again, now you're narrowing the investor audience who'd be interested in that kind of investment and a balance sheet investment, a company that runs a big balance sheet, and realize that the valuable part of the company was the distribution. We were thinking about, do we even separate these two companies and like separate the distribution aspect into its own company and leave the carrier separate? And that's what basically was part of what gave me the idea that I should just build a distribution company. Yeah,
Right.
it's a better market solution for advisors, and it's a better capital solution to raising money. We don't need to raise tens or hundreds of millions of dollars just to sit on a balance sheet.
Yes.
You can raise all growth capital. So a lot of things go into it, but it was for that business. It was a bit, we'd kind of run the course of what we could probably do as a standalone entity. And I think a lot of RIA firms probably get that way too right now, because at some point, those larger firms, and just in the same analogous way that we were looking at a carrier, they can bring more capability to you.
Yep.
They can bring as you were just mentioning, Corey, a marketing and growth engine, the people who can drive or help you drive organic growth. They can bring lawyers and estate planners and like all kinds of things that can help benefit in your practice. And you would just have a hard time doing on your own, or you take a long time to grow into it or eat into your profits or something. But the scale of one of those companies is just going to be beneficial to your business in a way that maybe you can't accomplish on your own, or would be very difficult to accomplish on your own.
Yeah. Yeah. I love that. So people want to find out more about you and DPL. Where do they go?
Go to dplfp.com, dplfinancialpartners.com, and that'll get you into our site. We're launching actually a brand new website here in like 10 days.
So
So
meaning by the time you hear this episode, it will have been launched, the audience.
we have been launched along with a new branding of our tech. So exciting stuff. And there you can find ways to get a hold of our team, talk to our consultants. Part of the value we bring to firms is not only the technology and the products, the capabilities, but the expertise in how you leverage it, how you do it, and how other firms have done it, what we've learned in helping businesses, the many, many we've worked with through the operational issues, the considerations, all that. Extremely valuable team, and get a hold of them through the site as well.
Love it. David, my final question on the podcast is always about my highest value in life, which is freedom. And for me, that means everything from freedom around the world for people from oppression to why I've been an entrepreneur for decades and haven't had a boss. What does freedom mean to you, and how does it impact your life and business?
Yeah, that's a great question. I wish I had thought of more about it. But freedom, yeah, it's definitely in the same way, not having a boss, though we all have bosses in some form or
Sure.
fashion.
My clients are my bosses. In fact, I joked to Dawn, who runs my office manager, like she's my boss. She tells me where to go and where to be. But yeah.
100%, 100%. I've got investors, right? So, but yeah, I do like that freedom. I'm not a big company guy. Came to that realization long ago in my career. I get too stagnated, big company. But no, I'll give a quick story. So my first job out of school was odd thing where I got hired by a guy I had interned with the summer before, and he donated me to a foundation that he was on the board of directors of. And that foundation worked with the CIA to resettle Russian defectors.
Wow.
And so after they got debriefed, and sometimes that took years, they'd be turned over to the foundation to help them find a place to live and a job and just get acclimated to the US. And it wasn't until talking to those people that you realized how much the benefits of freedom that we have in this country really mean. You're talking to people who are, high level, Soviet politicians who are, who had been, they were at the top of the country, and they're living in 1-bedroom apartments with their family, with a shared bedroom, bathroom and kitchen with 10 other families, and they had no freedom. And they chose to leave that country and even abandon their families because the oppression was so bad. And that was really the first time in my life I ever really had a different perspective. And it helps you appreciate America and the freedoms and benefits we have. And I think it's the most fundamental thing. And you just take it for granted. Like anything you're used to, you can easily take it for granted. But when you get a good experience of a place where there is no such freedom, it can open your eyes and bring some gratitude.
Love that. David, so appreciative of you coming on the podcast. I mean, obviously, just your general deal background, having raised capital, having been involved with a public company, having sold the company, having a company now that helps, folks create, organic growth and enterprise value, and understanding the RIA industry specifically. It's just been, we have a lot of general listeners on the podcast. I know got value. We have a lot of RIA industry listeners on the podcast that get value, and hopefully understand more about what you do and your solution, how it could benefit for them. So I really appreciate you coming on. Great job.
Thanks. I appreciate you having me. It was a really fun conversation, and great questions, and this was terrific.
Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. If you are interested in finding out more about my law firm, the services we provide to entrepreneurial and growing companies across industries all over the country, and my partner Brian Megan and I, and my amazing team, just head over to kupferlaw.com. That's kupferlaw.com. And if you want to follow more of my content, head over to my LinkedIn page where I post regularly. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.